Welcome to my pencast. I'm counting 11th in for Chapter 5 on inventory. And this time, our goal, we always have a goal, is to learn to journalize transactions common to selling inventory under the perpetual method. We've already learned how to purchase it. Now, how do we sell it? And we bring forward the same concepts we did, how to journalize, and the accounting cycle. And we're still working on the first part of the accounting cycle, where you have the general journal, even though your author calls it just a journal. We're going to learn how to journalize the transactions recorded to sell merchandise inventory to our customers. Those entries will be posted, as you know, to the general ledger, and then an unadjusted trial balance will be made to check the equality of our posting. So let's move on and look at entries that would be common to selling inventory. Our first journal entry is to record a sale on the 5th of January again, $5,000 worth of merchandise we sold one of our customers that cost us $3,000. The terms that we're giving our customer are 210 net 30, and it's FOB destination. So title transfers when it arrives at its destination, and we're going to have to pay the shipping costs. Put this pencast on pause and make an entry to record that sale. A little trickier. Let's see how you do. We record the sale of inventory, accounts receivable and sales at the retail, the amount we sold it for, and that entry immediately triggers us taking inventory out of the account inventory, because since it's a perpetual system, it needs to be taken out immediately. So we recognize cost of goods sold. It's an expense. For $3,000, the cost of the inventory, and an inventory credit of $3,000. This records the sale of our inventory to our customers. How about another transaction? In this transaction, you're going to pay the shipping costs on the sale from 1.5, and the shipping costs were $25. You pay them cash. Put this on pause and record payment of those shipping costs. How did you do? It was expensed immediately as a selling expense, freight out expense, $25, and cash. That entry had nothing to do with the procurement of inventory and everything to do with selling it. So by nature, it's a selling expense. Let's have another transaction. Let's assume the customer returned 50% of the goods that we sold them in transaction 5. Nothing was wrong with the goods, so we just returned them back to inventory. What would the entries be to record this return of goods from our customers to us? Put this on pause and make an entry. How'd you do? Let's look at our entry. The first part of our entry returns the sale and drops accounts receivable. Notice I go into a contra account, sales, returns, and allowance, instead of directly into sales. I want to keep track of how many sales and returns and allowances I have. That's a sign of an unhappy customer, and if that number starts to grow, I need to know it. I don't want it lost in the sales account because it hasn't been taken into account separately. And then the second part of the entry is triggered by the sales, returns, and allowances. I put it back in inventory, and under the perpetual system, it needs to go in immediately. And then cost of goods sold is reduced by the amount of my costs. So the first part of the entry is at retail, because I've sold it and it's come back. It was sold at retail and it comes back at retail. The second part of the entry is always at cost. How much did it cost me, that inventory? Finally, What do you think we should do for our last transaction? I'll bet you know. You knew it, didn't you? The customer pays their bill in full. Put this on pause and show me what that might look like. I've decided to change my discount to 3%. So your answer is going to be wrong. Ha! The reason I did that is I took my discount at 3%. So, let's go from there. It's okay if you're off a little. They owe you $2,500 and you give them a 3% discount. 2,500 times 97% is $2,425. And that will be the amount of cash that they pay you. You need to take $2,500 out of accounts receivable so that this account comes to a zero balance because they have paid you in full. So the credits to accounts receivable for $2,500. Sales discount then would be the difference, or $75, the 3%. Notice we did not bury that in sales either. So when you are recording sales of merchandise inventory, you record the sale into an account so named. You record the return and allowance into an account so named. And you record the discount into account so named. Sales returns and allowances and sales discounts are contra accounts to sales, or contra revenue accounts, so they have a debit balance. We'll talk more about that when we look at income statements for merchandising industries coming right up. Thanks for joining me on this Pinkcast, but before I go, I think I really want to back up and have you pay a bit of attention to that freight entry too. Remember, sales are put in account so named, returns and allowances in account so named, discounts in an account so named, and shipping costs when it's a sale or a selling expense, and they're put in account so named. Alright, now I'm ready to go. See you soon. Bye-bye.